Welcome to the Deep Dive, where we cut through the noise and give you the insights you need to stay well informed. Today, we're doing a deep dive into NVIDIA, a company that's not just at the forefront of the AI revolution, but practically building it. Their name is truly on everyone's lips, and for good reason. We've poured over their latest financials, the Form 10Q for the quarter ended July 27, 2025, and their August 2025 company overview presentation. Our mission is clear: to give you a crystal clear, investor-centric picture of their performance, their strategic direction, and critically, what it all means for you, the informed investor.
Exactly. We'll be distilling the key financial metrics, but maybe more importantly, we're going to try and understand the powerful drivers behind their impressive growth. We'll dig into their balance sheet and capital allocation strategies, and then pivot to their future objectives, dissecting the significant risks they're navigating. The goal here isn't just to, report numbers, but to connect them to the larger market trends and geopolitical currents shaping NVIDIA's trajectory.
Right. So, with NVIDIA often seen as a bellwether for the entire AI sector, the central question for us today is this meteoric rise truly sustainable? Or are the shadows of geopolitical risk and emerging competition growing longer than their, formidable balance sheet? Let's unpack this. Let's kick things off with the headline numbers, and frankly, they are nothing short of astounding. NVIDIA continues its remarkable growth trajectory. For the second quarter of fiscal year 2026, revenue rocketed to $46.743 billion.
Wow.
That's a jaw-dropping 56% increase year over year and a solid 6% sequential rise from the prior quarter. I mean, to grow by that much at that scale.
It's truly remarkable, yeah. And when we zoom out to the first half of fiscal year 2026, the picture's even stronger. Total revenue reached $90.805 billion.
$90 billion.
Right, marking a 62% jump compared to the first half of fiscal year 2025. These figures don't just underscore accelerating demand, they scream it. It tells us that NVIDIA isn't just riding the wave of AI demand, they're actively creating the market and cornering a significant portion of it.
And it's not just top-line growth either. The profitability here is also striking. Net income for Q2 FY26 hit $26.422 billion, surging 59% year over year and 41% quarter over quarter.
41% quarter over quarter.
Yeah. Diluted earnings per share followed suit at $1.08, representing a 61% year over year increase. These are the kinds of numbers that get investors' attention.
Absolutely. Over the first half of FY26, net income reached $45.197 billion. That's a 44% leap from the prior year, which translates to diluted EPS of $1.84, up 45%. What's truly remarkable here isn't just the sheer scale of these profits, but the efficiency with which NVIDIA is converting this demand into shareholder value.
Right.
For an investor, it signals a company with immense pricing power and operational leverage.
Okay, this next point on gross margin is what really caught my eye in these financials. Gross margin for Q2 FY26 was 72.4%. Now, that's an increase from 60.5% sequentially.
Pretty good.
But it's actually a slight decrease from 75.1% year over year. So soaring revenues and profits, but a slight contraction in gross margin year over year. What's going on here?
Yeah, that's a critical observation, and the company does offer an explanation.
Yeah.
The year-over-year decrease is attributed to their Blackwell revenue, NVIDIA's newest generation of AI accelerator chips.
The latest ones, yeah.
Primarily consisting of full-scale data center systems. These complete systems, they have the different, often slightly lower margin profile compared to last year's Hopper HGX systems. Those were often sold as individual components or maybe smaller clusters. So it's a shift in product mix, not necessarily a sign of weakness.
Okay, so a mix shift.
Exactly. However, the sequential increase in gross margin does reflect a significant recovery after that huge $4.5 billion charge in Q1 FY26.
Right, I remember that.
That charge was related to excess H20 inventory and purchase obligations, largely a consequence of those export control challenges we'll definitely dig into later.
Okay.
So for investors, the question becomes, how will this evolving product mix, selling more full-stack solutions combined with inventory management, affect these crucial margins going forward? It's a delicate balance.
Interesting. So if I'm understanding correctly, it's almost like they've gone from selling just the incredibly profitable engine, maybe, to now selling the entire AI supercomputer, which is a bigger sale overall, but maybe has more, components and a slightly different margin profile baked in. Is that a fair analogy?
That's a very apt analogy, yeah. It really highlights their strategic shift towards delivering complete integrated solutions, which while maybe slightly impacting individual component margins, strengthens their ecosystem lock-in and their overall market dominance.
Makes sense. Okay, on the expense front, total operating expenses saw a 38% year-over-year increase to $5.413 billion in Q2. The filings say this was primarily driven by strategic investments in compute and infrastructure, higher compensation and benefits due to employee growth, and increased engineering development costs for new products.
Right, R&D.
Given these operating expenses, do you see any areas where they might be, say, over-investing or maybe even under-investing for the long term, especially considering the competitive pressures and the sheer pace of AI innovation?
That's a crucial question. Looking at these figures, the increase in operating expenses seems, well, largely justified, given the explosive growth and the absolute need to maintain their competitive edge. The investments in compute and infrastructure, along with increased R&D for new product introductions like the Blackwell Ultra platforms, those are essential. They're spending to stay ahead.
Got to spend money to make money, right?
Exactly, to fuel that growth and to extend their lead. If anything, given the speed of AI development, underinvesting in R&D could actually be the greater risk here. The market expects NVIDIA to continually innovate, and these expenses are a direct reflection of that commitment. They pretty much have to do it.
Okay, these staggering numbers don't just happen in a vacuum. They're powered by specific engines within NVIDIA's business. So let's pull back the hood and see what's truly accelerating their growth, starting with the undeniable powerhouse, the compute and networking segment. Revenue here soared to $41.331 billion in Q2 FY26. That's up a phenomenal 56% year over year.
Just huge.
And for the first half, it hit $80.92 zillion, a 65% increase.
This segment is indeed the main driver. And the growth here is precisely what you'd expect from, well, the central nervous system of the whole AI boom. The robust demand for their accelerated computing platform is absolutely critical for training and deploying large language models, recommendation engines, all forms of generative AI apps.
All the stuff we hear about daily.
Pretty much. And the rapid ramp of their Blackwell architecture, including the new Blackwell Ultra platforms, that's a key factor here. It's a testament to the market's insatiable appetite for advanced AI compute, where NVIDIA holds a, frankly, virtually unrivaled position right now.
It's interesting to note, though, that data center compute revenue grew 50% year over year in Q2, but it declined 1% sequentially. What's behind that dip, especially when overall growth in the segment is so strong? For an investor, any sequential decline can be a bit of a red flag.
Yeah, that's fair. But that sequential dip is directly attributable to a $4.0 billion reduction in H20 sales, which ties right back to those export control challenges we mentioned. So it's not really a sign of softening demand for their core compute.
It's regulatory.
Exactly. It's an external factor. But offsetting that, networking revenue within this segment just exploded, up 98% year over year and 46% sequentially.
Wow.
This was fueled by their NVLink compute fabric. That's NVIDIA's high-speed interconnect tech that lets GPUs talk fast.
Right, connecting everything.
For their new GB200 and GB300 systems, and also the broader adoption of Ethernet for AI solutions by hyperscalers and consumer internet companies. It's also worth highlighting significant customer concentration here. Customer A accounted for 23% and customer B 16% of total revenue in Q2 FY26.
That's nearly 40% from two customers.
Both from compute and networking.
Yeah.
For investors, this concentration is definitely a point to monitor, as reliance on just a few large customers can introduce volatility down the line.
Okay. While compute and networking is undoubtedly the star, the graphics segment also showed strong performance. Q2 FY26 revenue was $5.412 billion, up 51% year over year. It's important not to overlook this traditional segment.
Absolutely. And this was driven by solid sales of their Blackwell architecture in gaming and professional visualization products,
Roviz.
alongside strong adoption of their self-driving platforms in automotive. Gaming revenue alone was up 49% year over year and 14% sequentially. What this tells us, kind of connecting it to the company's broader vision, is that NVIDIA is orchestrating two simultaneous massive transitions: accelerated computing and generative AI.
Right.
And they're enabling both with their full-stack computing platform.
This foundational strategy really explains the strong demand for their data center products, which the company describes as crucial for AI factories, a new class of data centers optimized for refining data into models and producing monetizable tokens. NVIDIA sees itself as the token generator in this new industrial revolution. That's a powerful narrative. But can you maybe elaborate on what monetizable tokens truly means for the average investor listening?
Yeah, that's a compelling metaphor, isn't it?
Mm.
Essentially, monetizable tokens
Hmm.
refers to the fundamental units of data and intelligence that are processed, generated, and ultimately, well, monetized by AI models. Think of it as the output, whether it's lines of code, generated images, insights from analyzing data, or even synthetic speech like you might get from a TTS system.
Okay.
NVIDIA is positioning itself as the critical infrastructure provider that processes the raw data into these valuable, intelligent outputs.
Yeah.
They're providing the picks and shovels, not just for the gold rush itself, but for the actual refining of the gold. That makes their role incredibly strategic and, yes, highly profitable.
Got it. So NVIDIA is growing at an incredible clip and investing heavily to fuel that. But what about the foundation beneath all this expansion? Let's examine their financial health, starting with a look at their formidable balance sheet and liquidity. As of July 27, 2025, they held a massive $56.8 billion in cash, cash equivalents, and marketable securities,
$56.8 billion.
which is significantly up from $43.2 billion at the end of January 2025.
This strong cash position isn't just a comfort, it's a strategic war chest. For investors, this signals incredible optionality. It's further supported by operating cash flow of $42.779 billion for the first half of FY26. That's a substantial increase from the prior year.
Huge cash flow.
Management states they have sufficient liquidity to meet operational requirements for the foreseeable future, including future supply obligations. This gives them immense flexibility for, strategic investments, aggressive M&A, weathering geopolitical storms, or simply outspending competitors on R&D. They're incredibly well positioned.
And they're not just sitting on that cash, are they? The company is actively returning capital to shareholders, which is always a positive sign for investors. They repurchased $9.7 billion of common stock, that's 67 million shares in Q2 FY26 alone.
Almost $10 billion in one quarter.
And a staggering $24.2 billion, 193 million shares in the first half of the fiscal year. That's a massive commitment.
It is indeed. And after the quarter ended, they bought back another $3.5 billion in shares between July 28 and August 26, 2025. Crucially, their board of directors approved an additional $60 billion in share repurchase authorization on August 26, 2025.
60 billion more.
Yeah, bringing the total available to an impressive $71.2 billion. This isn't just a vote of confidence. It's management putting their money where their mouth is. It clearly signals they believe their own stock is undervalued or at least reasonably valued, and that they have strong conviction in their future prospects.
Huge signal.
And this kind of aggressive buyback program can be a significant tailwind for EPS growth going forward.
Beyond buybacks, they also paid $244 million in cash dividends in Q2 and $488 million in the first half. They stated a plan to maintain future dividends, subject to board determination, of course.
Right. And their long-term debt remains stable at approximately $8.466 billion, with no commercial paper outstanding as of July 27, 2025. This indicates a very well-managed capital structure. They're aggressively funding growth and returning capital without relying on short-term debt, which is a sign of financial discipline and strength.
Okay, now let's pivot to a crucial area that carries significant weight for investors: government export controls. This has been looming for a while. In April 2025, the U.S. government imposed a license requirement for exporting their H20 product to China. This sounds like a direct hit to a critical market.
It was, and the financial impact was immediate and substantial, as we touched on.
Mhm.
This directly led to that $4.5 billion charge in Q1 FY26 for excess H20 inventory, because demand just plummeted due to these restrictions.
Right.
What's fascinating here is that while licenses were granted in August 2025 for certain H20 products to China,
Okay, so they got some licenses.
some, yes, but no revenue or shipments have actually occurred yet under these licenses. And perhaps more significantly, U.S. government officials have expressed an expectation.
An expectation, not a rule.
Not codified, no. An expectation of receiving 15% of the revenue from licensed H20 sales.
15%.
Yeah.
Wow.
This isn't just a sales hurdle, it's a strategic tightrope walk. If 15% of licensed H20 revenue might be claimed by the U.S. government, does this create a disincentive for NVIDIA to even pursue those sales?
Good question.
Or could it paradoxically accelerate China's efforts to develop fully domestic alternatives, creating a long-term great firewall for semiconductors that impacts everyone, It's really complex. This directly impacts their sales strategy and potential revenue from a key market, creating significant uncertainty for investors.
And beyond H20, there was that AI diffusion interim final rule, or IFR, back in January 2025. That would have imposed worldwide licensing on products like their next-gen H200, GB200, and GB300 chips. That's a huge scope.
Indeed, that would have been a massive game changer. Now, while that specific IFR was rescinded in May 2025 for a replacement rule,
Okay, so that specific one is gone.
right, but the scope and timing of that new rule remain highly uncertain. This regulatory unpredictability, coupled with potential responses from the Chinese government, inquiries into compliance, incentives for local competition, it poses a significant challenge. For investors, if we connect this to the bigger picture, it could severely disrupt their supply chain, impact long-term investment decisions,
Sure.
and even encourage customers globally to design out U.S. semiconductors from their products, creating a competitive disadvantage for NVIDIA down the road. It's a complex geopolitical chess match playing out.
Definitely something to watch. Moving beyond regulation, NVIDIA's rapid product introduction cadence, like the Blackwell Ultra platforms, it's a double-edged sword, isn't it? It drives innovation and market leadership, but it also creates challenges.
Precisely. While it keeps them ahead, frequent new releases can lead to revenue volatility. Think about potential quality issues if things are rushed, increased inventory provisions for older generations,
Or customers just waiting.
or customers postponing purchases, exactly, waiting for the latest and greatest. Plus, we're seeing the rise of high-quality open-source AI models. Now, if these models can be developed effectively on competitor hardware, NVIDIA's platform influence could potentially weaken.
Interesting point.
It raises an important question about their long-term moat and how sustainable their current dominance truly is against a potentially more democratized AI development landscape.
Despite these challenges, though, NVIDIA's long-term strategic vision is clear and ambitious. They see a future of AI factories and sovereign AI. How does this vision actually play out?
Well, it's an incredibly ambitious vision that leverages their core strengths. The company believes countries are recognizing the need to develop AI using their own data and their own infrastructure. This involves transforming national data into sovereign AI for national companies, startups, and governments. NVIDIA positions itself to enable this by building end-to-end AI infrastructure with their full-stack compute-to-networking technologies. They aim to accelerate every workload, from data pre-processing and model training all the way to agentic and robotic AI inference across every market segment.
So they're not just selling chips anymore.
No, they're selling the entire blueprint and the tools to build the future of national AI capabilities.
Yeah.
It's a much bigger play.
Another interesting point from the company's overview presentation is the strong focus on sustainability. They highlight the Blackwell platform's 25x improvement in energy efficiency for LLM inference compared to the previous Hopper generation. For investor listening, is this just good PR, or is it a genuine competitive differentiator?
I think it's more than just PR. This commitment to energy efficiency is becoming a strategic imperative and a genuine competitive advantage. As these AI factories scale globally, they're facing immense energy consumption and capital expenditure constraints. It's a huge issue.
Absolutely. Data center power needs are soaring.
Exactly. So NVIDIA's Blackwell platform, with its 25x improvement in energy efficiency for large language model inference, that could become a decisive factor in winning massive long-term contracts. Think energy-conscious cloud providers, corporations, and even governments building their sovereign AI infrastructure.
Right. It lowers the total cost of ownership.
Precisely. It transforms a major operational cost center for their customers into a competitive advantage for NVIDIA. It aligns with major ESG trends and could unlock further demand. It positions them not just as a technology leader, but as a sort of responsible partner in building the future.
Okay, so to sum it all up, NVIDIA is reporting explosive revenue and profit growth. It's driven by their dominant and increasingly integrated position in accelerated computing and AI, particularly within that compute and networking segment. They're aggressively returning capital to shareholders through massive buybacks, and their balance sheet, with its vast cash reserves, is incredibly robust.
However, the path isn't without significant hurdles and complexities. The evolving landscape of government export controls poses real, tangible risks to revenue and market access. That's clear. The intricate balance of rapid product introductions against potential quality issues or inventory challenges, and the competitive dynamics of the open-source AI movement all demand vigilant attention from investors. The company's ability to shrewdly navigate these geopolitical and market complexities will be absolutely key to realizing its ambitious vision for AI factories and sovereign AI.
So, with NVIDIA transforming raw data into these monetizable tokens and countries viewing AI factories as essential national infrastructure, one has to wonder, how will the balance of power shift between nation states and tech giants in this new digital economy? And what unforeseen opportunities or risks will that create for investors like you? It's a fascinating landscape developing.
Definitely something to keep thinking about.
Something to chew on. We hope this deep dive into NVIDIA's latest financials helps you stay informed and ahead. Until next time, keep learning, keep questioning, and keep deep diving.